Welcome back. The U.S. futures contracts, as we've showed you several times, are rallying. This comes after the latest consumer price index number in the U.S. Inflation showed core inflation unexpectedly slowed in December. We're joined now by Jan Nevruzi, U.S. rate strategist at TD Securities. Jan, thanks a lot for joining us. Take us through the market reaction here. The inflation numbers were essentially in line with expectations, but the market is responding enthusiastically. What does the market see here?
I mean, that was a good CPI number. I would even say it was probably a little bit better than what the market was looking for. It is a good number for the Fed. And like you pointed out, the Treasury market, we're seeing a pretty big rally already in yields. And bonds have reflected that reality that inflation is just reaching or getting closer to target. The core was 0.2 on month. So that's very much in line with what we would want to see on a longer term horizon. Now, within the components, we saw something like the goods part of inflation coming lower again at a very basically close to zero, which is a trend similar to the pre-pandemic days. Last month was an aberration. We've kind of gotten past that. Similarly, the pass-through to the core PCE, which is the Fed's preferred inflation measure, will be pretty good as well. So I think this just pushes back against the narrative that inflation is reaccelerating and that financial conditions are too easy here.
And what does it do to expectations of the future path of the Fed? I guess it makes it less likely that the Fed would contemplate a rate increase. That's always been a very outside possibility. But what does it do to expectations of rate cuts coming from the Fed?
Yeah, starting with the rate hikes, we think the bar for that is very high, much higher than what the markets are implying right now in terms of derived from options. But other than that, we think it's too soon for them to come back and start cutting rates again. They have communicated well that perhaps waiting a little bit might be prudent as the growth side of the economy is doing well. So we believe that the economy is reaching this steadier state in growth rather than reaccelerating, which is a narrative that we like to push back against as well. And finally, there are a lot of uncertainties around the new administration. For example, tariffs will have at least a one-off inflationary impact. The Fed probably wants to see how those play out, how inflation expectations behave, and be on hold. That's what we expect. Similar to last time we spoke, we expect the Fed to be on hold for the first half of the year and then resume cuts in the second half.
You think the Fed is looking at the incoming U.S. administration, considering the possibility that some Trump White House policies will be inflationary, and you think that will put the Fed on the sidelines until at least the second half of 2025, correct?
That's right. Yeah, I would think that. I mean, some of the FOMC officials already incorporated some assumptions about what the new administration might deliver into their forecast at the latest meeting. There's a lot of uncertainty around even within the Fed of what they see the new administration will do and how the impacts will spill over through the economy. So wait and see is the better approach right now, and we believe the Fed will go down that route.
Now, another thing that equity markets tend to like is a strong U.S. economy. This economy in the U.S. Looks pretty good to an outsider. Inflation returning to the 2% target, strong employment growth, and nowhere near to a recession. What is your take on the overall state of the U.S. economy?
Yeah, I mean, we also don't anticipate a recession anytime throughout this year. But at the same time, I'd like to point out that the economy is more or less moderating. It's not. We don't think it's reaccelerating. And when you have a situation where the Fed's on hold, the economy is doing well, not reaccelerating, and inflation is coming down. But at the same time, if the Fed has a bias to ease down the line, I would think that bodes well for owning fixed income, particularly longer-dated fixed income here. If the Fed remains on hold for the first half, things like 10-year Treasury yields are certainly attractive, and we like longs in that part of the curve.
We don't hear the phrase soft landing very much anymore. That used to be, as you know, the big debate among investors, whether the Fed could or could not engineer a soft landing. Is that debate over now? Has the Fed accomplished that soft landing?
It definitely feels like the consensus view now. If anything, I would, the current environment feels more like peak excitement about the economy, that things are doing or are going to do much better than what we anticipate, and that we're going to see this miraculous reacceleration. We just think some of that is driven by, whether the seasonality early on in the year or just like some, dynamics pre-election, but we certainly don't anticipate a reacceleration. But yeah, I guess I would agree that the soft landing has more or less been, I don't know, you can call it achieved, or we're certainly getting there.
I'd love to get your take on whether fiscal policies that we expect from the Trump administration and the tariffs that we expect from the Trump administration will be significantly inflationary in the U.S. economy. What's TD's view?
So we see impact from tariffs as lifting the price level. We don't necessarily see it as a continuous inflationary impact. So towards the middle of the year, yes, we will see. We expect about a percentage point increase in inflation for 2025 because of the tariffs, but we certainly don't expect this entrenchment in inflation expectations or like a feedback loop where you would keep seeing inflation persistently higher and the Fed having to react with rate hikes. Instead, we expect that might have a negative impact on growth down the line, which might bring back the Fed into cutting rates. The fiscal story is, I guess, much more complicated in a sense that we simply don't know which decisions will be prioritized. We could certainly see an expansion of the deficit with the renewal of the tax cuts, but that's a story that's going to play out in next year and beyond, not in the next 6 months or so.
Jan,